Hi, welcome to Chapter 8, Hospitality Accounting. Today we're going to talk about the accounting cycle and give you a little demonstration. So the accounting cycle is the sequence of accounting procedures performed during an accounting period. First, you would analyze and journalize transactions. So if we're talking about a period of a month, anything from the beginning of the month to the end of the month that happened, all the transactions, you would analyze and journalize them. You would post them to the ledger, and then you would prepare a trial balance. Then you would prepare any needed adjusting entries. You would prepare the financial statements. And finally, you would close temporary accounts. So temporary accounts would be any revenue and expenses. And prepare the post-closing trial balance. The next thing we want to talk a little bit about is the basis of accounting. There are two types of basis you can use. One is a cash basis. The other one is an accrual basis. Cash basis transactions are recorded only when cash is received or paid. It is very common for small businesses and sole proprietors to use a cash basis of accounting. It is not a generally accepted accounting method, so it is not GAAP. If you were a publicly held company that was doing stuff with the SEC, you would not be able to be on a cash basis. But if you were Jack's Landscaping Services and you wanted to be a cash basis taxpayer, you could be. You could do all of your work under a cash basis. The IRS will allow you to report your revenue and expenses under either basis. The other basis of accounting is an accrual basis. That's what we've been focusing on throughout our study of accounting. Revenue is recorded when earned, and expenses are recorded when incurred, regardless of cash flow. So to give you an example, if you were to babysit for me today, and I said, I don't have my checkbook, I'll pay you later, you would still record the revenue now because you've babysat, you've earned the money. And when I pay you later, you would just record the cash and relieve the receivable. You wouldn't record revenue. And again, I would have to record the expense of babysitting now, even though I was paying you cash in the future. And that is the generally accepted accounting method. So that's what Target, Gap, Walmart, Coke, US Airways, any publicly traded company you can think of uses. It's required by the Securities and Exchange Commission as the appropriate method for accounting for revenue and expenses. So the next thing your book talks about is chart of accounts. Chart of accounts is a listing of all account names with their account numbers. It is used by most businesses as an easier way to track things. You use all of the account numbers to keep them in order. The chart of accounts also has a specific order in accounting, so it's understood universally. Asset accounts are listed first, and they begin with the number 1. Accounts are listed in the order of liquidity. That means liquidity means that it's eased to be converted into cash. So current assets are listed first. Liability accounts are listed second and begin with the number 2. Current liabilities will be listed before non-current liabilities. Again, that's in order of liquidity. Equity accounts are listed third and they'll begin with the number 3 in a chart of accounts. Revenue accounts are listed fourth, and they will start with a 4. Cost of goods sold accounts are expenses, and will start with a 5. If businesses don't have a cost of goods sold, they may use that for other expenses, or they may skip number 5. All other expense accounts will be 6, 7, 8. And depending on how big the business is, they may use that to break up their expenses into different categories. But if you were to look at any chart of account, should be assets 1, liabilities 2, equity 3, revenue 4, and the expenses being the remaining numbers. And that should help you to understand things when you're working in accounting and working with accounts. At the end of the month or the end of the period, all temporary accounts are closed. Temporary accounts are revenue and expense accounts. So sales revenue, rent expense, they're all closed at the end of the month. And the reason for that is it's more helpful, it's more meaningful. If I said to you, I've been in business for 10 years and I've made $1 billion, that really doesn't help you to understand my business. What would be more helpful is to say, okay, in the first year I made 0, in the second year I made 500, in the third year I made $1 million, in the fourth year I made $2 million, and so on and so forth, so that you can do analysis. So it's important that we close our revenue and expense accounts so that we can do analysis and comparison and have more meaningful numbers. Other accounts, like balance sheet accounts, are not closed because they're associated to something else. Like I have $100 in shares. So it doesn't make sense to bring that to zero. I can actually say, okay, this represents $100 in shares. Or if I have a loan for $500, I can't discharge that loan simply because it's the end of the month. But temporary accounts like revenue and expense are closed. In a manual system, a worksheet is created to prepare adjusting entries and closing entries. In a computerized system, the computer program will automatically prepare and post closing entries. So if you're in a manual system, you have to make the journal entries yourself. If you're using a computer, it knows which ones are revenue and expense accounts because you've coded them that way to the computer, and they will close automatically and post the entries. Adjusting journal entries are very important. They're made at the end of the month. The purpose of adjusting entries is to bring the general ledger up to date to comply with the revenue recognition principle and the matching principle. So what this means is that some accounts need to be corrected because they're originally recorded as something else. So if you're going on a plane, you purchase your ticket today, even if you aren't going until this fall. You pay them $500. They can't record that as revenue until you fly. So at the end of the month, they would update all their accounts for everyone who's actually flown and make the adjustments. The matching principle says that expenses should be matched in the appropriate period. So some accounts like rent and insurance, we pay in advance. And as the month goes by, you would recognize the expense because you've incurred that expense. Depreciation is another common adjusting entry, but we do that further on in your book. So we'll talk about depreciation extensively when we get to the depreciation chapter. In the meantime, let's look some more at adjusting entries. I have some examples for you. I have supplies and insurance. So what would happen is you would buy supplies at the beginning of the month and you would show this $100 right here that you have as a beginning balance. The month would go through and you would use the supplies, paper, pens, ink, highlighters. And at the end of the month, you would go in and look and see how much do I actually have left of the supplies. You probably use some of them up during the month because that's why you bought them. So I go and I determine that I actually have $50 left. I have $50 here that is left in supplies. So I need to make an adjustment. I need to decrease my supplies account to show that I've used up some of the supplies. So that's what I'm doing here with this credit. I'm decreasing the account. I had 100 and I subtract 50. I'm going to have $50 left in supplies for the future. And when I recognize the decrease to the supplies account, I'm going to likewise recognize that I have supplies expense here for $50. So I'm going to recognize that I have used $50 worth of supplies for the period. Oops, I just want to come down here. So now we're looking at prepaid insurance. So what happens with insurance, you probably have this with your own car insurance or your life insurance, is that you have to pay it in advance. It'd be very nice if I could drive around in my car and then if I was in an accident, call up Flo and say, hey Flo, I need some insurance. But that doesn't how it works. You have to pay in advance. So here I've paid $600. So here I've paid $600 for a 6-month insurance policy. So what I'm going to do is I'm going to say $600 divided by the 6 months. I'm going to use $100 per month for that insurance. So that's what I'm going to do here. I'm going to say I started with $600. I went all through the month and I drove my car. And just with the passage of time, you use up insurance. So I use up that $100 that we calculated here. And I'm going to have $500 left of insurance for the future. And once I recognize that I am decreasing prepaid insurance, so I'm taking the account 600 minus 100 equals 500, I want to also recognize that insurance expense. So I'm going to recognize $100 in insurance expense for the period. So those are 2 examples. Be sure that you look through your chapter for more examples, and when we do the WIMBA session, I'll also go through some more examples of adjusting entries. The next thing we want to talk about is computation of net income or loss. And we kind of talked about this a little bit in the beginning when we talked about an income statement, which showed net income or net loss. The first thing you're going to do is add sales and other revenue accounts. So if you're a restaurant, you might have food sales and beverage sales and liquor sales. You would add up all those revenue accounts. And then you'd subtract the expenses. Expenses like cost of the food, cost of the beverages, cost of the liquor. You'd subtract other expenses like insurance expense and wages expense, all of that. And if revenue is greater than your expenses, you'll have net income. Of course, if your expenses are greater, then you would have a loss. So that is a brief overview of Chapter 8. Thank you for watching and listening. Please be sure to read Chapter 8 along with watching this PowerPoint video. Thanks so much and have a great day.